So hi everyone. So after the month of July and September, when we saw a good recovery in the market again from 15,000 to 18,000, we have seen again the market is not breaking out. It is still in a broader range, and the reasons remain the same: the higher inflation, the sticky inflation in the developed markets, the high energy prices in Europe, which is hurting that economy, and then finally the higher interest rates in US. So which is in fact which has come out higher than what the market was expecting, and that finally led to the recent decline in the emerging markets. So let us see how the things can pan out in the month of October now. It is very interesting because we are moving into the festival season, and that is where we are expecting more discretionary expenditure to come out, whether it is into hotels, whether it is into entertainment, whether it is into consumer discretionary themes. So that is where it is an interesting phase where some global headwinds are still there, but domestically the things are looking actually much better in India. So if you see right now, one of the major challenge for India is that our forex reserves have come down. So we were at record highs of $640 billion actually in 2021. And that time we had a import cover of almost 16 months, because when we are importing crude, we have to pay in dollar. This forex reserve is in dollars. And when the RBI was defending rupee by selling the dollars, ultimately the forex reserve has come down. It has come down closer to $545 billion now. And it is a cover of around 9 months now for import. So this is where, if it comes down further, obviously this will be a situation which can create some jitters in the domestic currency, and thereby the equity markets can also remain jittery actually for some time. So this is a very important aspect that we have to watch in the coming days. When you look at the US Fed outcome, the dot plot, so obviously previously market was expecting 3.5%. It has come out to be closer to 4.25%. And in 2023, there may be a little higher, more, possibly 50 bips of rate hike. But in 2024, the expectation is that it will start coming down. So this is a very clear target of US Fed, that when the inflation is high, they are targeting it. This is the sole target for US Fed right now, and they can sacrifice some of the growth. This is what they are talking about. And that is where S&P actually has come down. The equity markets have come down in US, and they are back to 2020 levels. That is very close. And this is where the underperformance of US vis-a-vis India is very, very visible. If you see the interest rate scenario in US, it is around 3.25% currently. But because the projection was 4.25%, we have seen the bond yields in US Treasury, it had already gone closer to 4%. It declined just because the UK central bank, it declared that they will be buying some bonds after the very sharp move in the bond yields when they declared the tax cuts on the back of borrowing. So that was not taken positive by the bond market. Bond yields moved up, so immediately they had to declare some kind of bond buying. So that is where actually there was some relief in the bond yields in US. Otherwise they have already touched 4%. If you see the euro weakness vis-a-vis dollar, so that is still continued because energy prices in Europe are still high. They are moving into winter season. There are jitters whether they will face the problems again when the embargo will be completely there on Russia going forward from the December onwards. So euro has come into discount. It was 1.25 if you remember last year against dollar. Now it is in discount to dollars. So US dollar index, because euro has a very high weight in dollar index, that has actually moved up to closer to 113, 114 levels. And if you look at the previous high in dollar index, it was 120, which was made in 2002. And before that, the and the further high was made at 160 in the year 1982. So after every 20 years, we are seeing a rally in dollar and it is making a lower tops. So we have to see whether it respects the previous top of 120 and finally starts cooling off before reaching those levels. And because the recent hawkish statement which has come out from US, I think this is one of the most hawkish statement we have seen. That is what market is factoring, one of the worst scenario already now, whether it is in bond yields or whether it is in equity markets. So USD INR has in the recent period, if you see emerging market currencies, particularly Indian rupee, it was not depreciating that much. It was hardly 5% decline year-on-year basis. But recently from 79.5, immediately it moved closer to 82 because after this hawkish statement from the US. So if you see the very important part, whether inflation is going to peak out, because interest rate trajectory, though I think US Fed has already announced. Now the thing which has to be seen is whether the inflation is going to peak out eventually there or not, because commodity prices have come down. An important thing is that people were not going for jobs, and that is why the wage inflation was very high in US. And if you see one of the indicator, unfilled vacancies, because when people were not coming for jobs, the unfilled vacancies, if you see in this chart, it was continuously high. Now those are tapering off. That means when people are coming back, we are seeing that the unfilled vacancies have started getting filled and it is coming down. So this is a sign that wage inflation can cool off going forward, and which has a high component in the US CPI. Unemployment rate obviously is 3.5, but we should give more weightage to this particular chart, because when people were not coming for jobs since September till September 2021, just 1 year back, it was a direct money which was given into the hands of citizens of US and outside people also. And that was a reason why for certain period they were not coming for jobs. But now it is the normalization is happening, which can cool off this particular wage inflation, which is very high and which is leading to this high US CPI numbers. Now, if you see, and obviously here you can see the labor participation, which is coming better. This is another aspect, used car prices, which had seen a sharp jump actually last year. But now the base effect is also coming into picture, and simultaneously the semiconductor availability is also there. And that is where the used car prices also are tapering off. So all of these, along with the commodity decline, whether it is aluminum, copper, crude, we believe that there may be some peaking out of US CPI inflation now. And that is where whatever rate hikes are being announced in the recent period by US, ultimately you will see that it will result in the toppest formation of the inflation. If you see the real interest rates in India vis-a-vis US, so obviously in US it is deep negative. It is almost 5% negative, but in India still it is positive. And that may be one of the reasons why the Indian markets are still very resilient. The US CPI inflation is very high, and it has just tapered a little actually from 9.1% to 8.3%. But India CPI inflation is still under control. In fact, in 2012-13, so we had seen the level of 12%, and now it is somewhere closer to 6-7%, 7% around. So overall, looking at the interest rates in India currently, our 10-year GSEC yield is still higher than the inflation levels, and that is why we have the real interest rates positive in India vis-a-vis US, which is quite negative. And this is where the underperformance is coming in S&P 500, because S&P 500, if you observe from March 2020 levels, it has come closer to those levels now, hardly 4-5% away. 3,400 was the level in March 2020, and it has already reached to 3,580 levels now. In Nifty, we had 12,400 as the pre-pandemic level, but still we are 26-27% higher from those levels. So Indian outperformance can be clearly seen from these indicators. And I think going forward, we have to see whether S&P drags Nifty or ultimately Indian markets remain range bound here and finally give a breakout. We believe, considering this outperformance so far, despite the FI outflows, because more than 3 lakh crores of outflows we had seen, even if this particular outperformance has remained, it has a lot of things to be seen. I think it is very much possible there may be time correction continuing, but eventually the breakouts can come on the higher side in Indian markets. If you see the outperformance over MSCI EM from the Nifty perspective, we have seen almost for the 10th consecutive quarter that outperformance has continued. So whether it is US or whether it is MSCI emerging market, we have seen Indian markets have stood actually altogether different. Now, some of the basics which are coming better for India, obviously the corporate profitability to GDP has moved up from 2020. Now in 2022, it is somewhere closer to 4.3%. So it has moved very fast. In fact, the Nifty last September when it was 18,000, the price to earning of Nifty, because when the EPS is growing, the price to earning has got normalized. Last September, it was 23 times 1 year forward, and now it is closer to 18.5 times 1 year forward. So that shows that with the EPS growing and profitability growing, the market valuations are getting normalized with this time correction. So obviously the revenue collection from the government is quite robust. In financial year 22, the average monthly inflow was expected to be 1.05 lakh crores. It came out to be 1.24 lakh crores. Financial year 23, the expectation is 1.3 lakh crores, but now last 6 months continuously we are seeing the figure is coming above 1.4 lakh crores. Because in September 2020, when all this started, we saw that it was more than 500 crore turnover corporates where the digital invoicing was mandatory. But now from October onwards, it is even more than 10 crore turnover corporates, the digital invoicing is mandatory. And that is bringing more and more people into the bracket of GST, and the numbers are increasing actually. And this is exceeding what in the budget the government had expected. So tax to GDP has started reverting back, and this is where the government has got a courage. If you see the borrowing numbers for financial year 23, it was expected to be 14.3 lakh crores in the budget, but now actually it is happening to be 14.2 lakh crores, so lesser than by 10,000 crores. So why it is happening? Because of these numbers. GST numbers have grown by 33% year on year. Direct tax numbers have grown by 22% year on year, and that is where the 6.4% of fiscal deficit target of the RBI is likely to remain actually intact, and it will not go higher because the borrowing is not happening beyond the limit, rather it is lower than the limit. This is good for macros in India. If you see the consumer discretionary, now this is very interesting. As I said in the beginning, the festival season is there, and we can see many discretionary themes participating now. Hotel stocks, where the rates are already 20% higher than the pre-pandemic period, they are already participating good. Look at the property registrations right now. So in Mumbai, we have seen the record 8,600 property registrations in September. This is the highest in the last 10 years. And if you see this particular share here, the share of above 1 crore, here we have seen more transactions happening up to 1 crore and up to 2.5 crore. If you see the percentage share, this is much higher actually in this particular segment. So this is really encouraging that in the middle ticket size segment, more and more people are coming now. And I think this is where you have a higher base, and it can lead to actually much better growth going forward in this segment. When I look at the real estate growth, so obviously why it is happening and what exactly is happening, both are important. So if you see the property registrations, it is not like only in September it has happened. These numbers are coming continuously better if you see the last few months of scenario. And simultaneously the affordability is also has improved. Housing prices to annual income ratio, if you see, it has come down to 3.2%. So this, because of this affordability getting better, even if the interest rates are going up now, because interest rates were very low, even if 1-2% of interest rates going up, I don't think that is going to impact this affordability too much. In fact, you look at from 1990 onwards, whenever the inflation has gone higher, the housing prices actually have picked up. So the same trend we can see now when the inflation is a little sticky, when the interest rates are following up, and we can see that the demand or the prices in houses can see some kind of more revival actually going forward. So this has been a trend. When there is more when the inflation is lower, in those periods in the last 3 decades, we have seen that the home prices also have remained lower, the demand has remained lower. So this is a good correlation with the interest rate scenario. Now, if you see the commodities, they are under pressure continuously. This is a recent number. Whether you look at aluminum, you look at copper, steel, iron ore. So all of these are still lower because the dollar has moved up. There have been talks of recession. You cannot have both the things together. When interest rates are moving up as a reaction of inflation, simultaneously there is a talk of slowdown in the economy. So obviously the US Fed is pressing the button to slow down the economy. It is very much required, and that is the reason actually that these commodities have come down. So iron ore generally goes as a raw material to steel, and if you see, even if the output prices have come down, the raw material prices actually have come down quite significantly. Crude, which was the last man standing, finally we saw that crude also declined. So now we have to see from $80, $85 what kind of movement comes in crude, because there is an expectation that some kind of supply cut may be there going forward by the OPEC or OPEC plus nations. So yes, it has come down from precarious levels, but from 85, $80, what kind of reversal comes in crude, that has to be seen going forward. If it remains broadly within 85 or $95 range, I think that will be taken fine by the markets. Now, from the automobile sales number, because consumer discretionary pickup we have seen, if you see the car industry, it has recorded highest ever wholesale deliveries in a month, in the month of September. You can see Maruti Suzuki year-on-year number 104% of jump. Month on month also we have seen 7% of jump. In fact, from April to September, if you see that financial year 23 so far, year-on-year 52% of jump. The forecast was negative. So these numbers now, automobile numbers are surpassing the expectations. So if you see whatever forecast were there for financial year 23 so far, all of them are coming better. And that is where the money flow can be seen into the automobile space, whether it is car or SUVs in the passenger vehicle or two-wheelers. There also you can see some recovery now. In fact, tractors, if you see Escorts, they are because Mahindra numbers are going to come now, but Escorts numbers we have already seen, which is much better in tractors. So tractors also have seen the reversal. So all of these segments broadly are seeing a better reversal. In fact, before festival, if you see the passenger vehicle segment, generally car manufacturer, they supply the wholesale delivery to the dealers in anticipation of a better demand on the retail side. So this is a trend, and this has picked up actually this time because things are opening up. So overall, it is good for automobile industry, and it looks like it has been, because it has been a late mover, we can see much sustainable recovery in the automobile space now. And when the crude prices are also lower, and there may not be a very sharp increase in interest rates in India because our inflation remains in control, and we had a good monsoon also. So I think that is where our automobile space can come little better. And on the top of it, the semiconductor availability also has improved relative to the previous months. Now, whether it is in the consumer discretionary, one theme is the paints or the fast moving electrical goods or pipes. Now, if you see in paints from the pre-COVID, we have seen a good recovery of almost 17% now on a CAGR basis, which is very heartening. So that is the reason that Asian Paints has recovered very nicely. And because the crude prices have also come down, you will see the benefit in the results of these companies in H2 financial year 23 now. So consumer durable also has seen that. In fact, these are Phoenix Mills numbers. There also we have seen that there is a good recovery of consumption actually, whether you look at from July to August 2019 numbers to July and August 2022 numbers. there is a good recovery from the pre-pandemic now. So it's a real move which we have seen now, and it's all you can say it was pent-up demand which is coming back to malls, and it is coming back to other consumption themes. But it looks like it is very aggressive, and it is likely to sustain for some time now. If you see hotels, so we have seen a recovery, and in fact, as I said, the revenue per the average user now room now for the hotels, we have seen 6% higher than the pre-COVID period. So and the rates are 20% higher now. So it looks like that this broader theme of consumer discretionary can be a good savior now for Indian markets from the equity portfolio formation. So you should continue to look at this at least for another 3-4 months. One important factor which is supportive for the discretionary consumption is the formal sector wage growth in India. So we have seen a sharp recovery in this particular space, and when the wages go higher, obviously that money comes or converts into more disposable income, and that comes into the discretionary part. So this has seen a 16% jump this time. So we are expecting actually good recovery in this particular space. Now coming from the consumption, now we are moving into the core capex theme, because that is a continuous theme in Indian markets. And if you see right now, the exports from India to developed nations or to the nearby nations, the merchandise export actually was almost around $300 billion from 2012 till 2020. It has seen a breakout. It has seen a structural change towards $420 billion. There may be few months when it will remain erratic, because as we are hearing, the retail sales in US, the inventory has gone higher, so it has been halted, so the exports can be checked from India. You can see some trade deficit increasing for a few months, but overall it looks like it's a structural change, which is very heartening from the export perspective, merchandise export perspective from India. And if you see the capex, whether it is the state capex, center capex, or the listed companies, because previously we were talking about that listed corporates, they may not start doing the capex immediately because of higher inflation and picking up interest rates. But if you see the numbers here, we have already seen from 5.2, it has moved to 6.5 lakh crores. And the overall government capex has almost come closer to 21 trillion, actually 21 lakh crores now. So the capex theme continues, and that is the reason the sectors like capital goods, they can start performing, and they can do much better actually going ahead. Now, if you see the tendering also in India, so the tendering has improved. Last year it was close to 2,33,000. Now it is 3,70,000 actually, the numbers are. So it is a much improved number in terms of this. So I think there may be better order visibility now for the companies, and you will find more winners from this particular capital goods space going forward. Now we have identified 10 themes for you for where the major capex is going to happen in Indian markets going forward. Obviously it is infra, because it is driven by the government. We have already seen the government capex from 1.4% of GDP. It has gone to 2.9% of GDP as budgeted for financial year 23, and it is rolling on continuously from roads to railways, from metros, new wagons, etc. Now, second is housing. Housing capex after almost a decade is seen. After 2012, it was a lull period for 8-10 years. Now we have seen that housing capex has revived. I discussed the registrations in Mumbai, which is record high. So I think this is something that should remain watchful. It is not like only the real estate companies you can look at, because there is always a cash flow problem there or visibility problem there. You can look at the building material companies, which I discussed, about the paints, about fast moving electrical goods, about pipes, about plywoods. So I think those kind of segments you can look at now. Now, another capex story is renewables. And I think this is where the companies are, getting traction. For example, take the case of Reliance. If Reliance is seeing any kind of growth, it is because of two reasons right now. One is the Geo, and the other is renewables. So what 75,000 crores they are putting in for green hydrogen, I think that is what market is eyeing at. So similarly, those companies which are looking for green capex, I think they will remain in highlight going forward. Data centers. So when you are looking everything from the cloud perspective, we are seeing more and more data centers are opening up in smaller cities. This has been the trend seen in China. In India also, we have seen there have been some real estate developers involved, and there are some IT companies also involved in this case. So I think the telecom companies can also come into picture, because ultimately you need a data connectivity here. So that is the reason why the telecom companies have already started performing, because 5G capex is already announced. For example, Bharti has declared 45,000 crores, Jio 85,000 crores, and the money has to be paid over the span of 10 years now. And the ARPUs are in focus in telecom. Average revenue per user, it is already reaching 178. I think another tariff hike can be seen before the 5G implementation, and that will take the ARPUs above 200. So that is the reason why these stocks are looking better even in the jittery market. Logistics, there has been a new logistics policy announced by the government. So government is equally on it, that they have combined various ministries and they are bringing on a single platform the Ministry of Road, Ministry of Finance, Ministry of shipping. All of them are coming actually on a single platform, so that whatever movement is there of the vehicles, it should be real time. And if it is real time, I think it will be a much better tracking. And ultimately, the goal of the government is to reduce the logistic cost from 14-18% of GDP to 8% of GDP in India. And for that, finally, they are building up the digitization in the logistics space. So finally, the other is digitization. So digitization is a very broad theme. Nowadays, though, the way we have seen it has spread out in India through UPI. I think it is one of the highest spread we have seen in any country so far, with the length of India, the kind of population we have. So even a small vendor is doing transactions through, UPIs. So our sense is the base is built up now, and from 3.2 or $3 trillion when India will start moving up, and if they already have a base of digitization now, so it is much more beneficiary and pushing force now for the economy, that we can have a very faster growth going forward. If you see electric vehicles, this is another theme, and the companies have already announced. Mahindra, Tata Motors, they are at the front, and that is where Mahindra has got a good traction. It is there in our portfolios also. And there may be vendor companies in EV. There may be some companies, which are providing material to batteries. It's not like a battery manufacturer, maybe a vendor to battery manufacturer. They can also come into picture, etc., etc. So EV is a concept which is coming up fast, and I think that is where the capex is going to be laid out. Defense, the first time I am seeing the kind of execution happening. We have already started exporting now. When this government came, it was hardly 1,000 crores of export. Now it is 13,000 crores of export. So we have moved up, quite substantially in the export part of defense, and our import also will be reduced now. More manufacturing is happening in India, whether it is in radars, whether it is on aircrafts, the aircraft carrying ships. So Vikrant, we have already seen coming out. So I think it's a good trend, and this is a very serious attempt by the government, and that is why these companies can have good time, who will be the beneficiary of this capex. Manufacturing and engineering design. So we have already seen the companies like Siemens, ABB performing in industrial automation. In the manufacturing part, it's a very wide theme. Wherever the PLI benefits are being given in the sectors, those sectors actually will be a good performers going ahead. Mineral water will remain in scarcity going forward. So I think this is one scenario that companies can look at to acquire the mineral water companies. For example, look at Tata Consumer Products. They had Himalaya in the portfolio. Now they have Bisleri also in the portfolio. So that is something I think will be the major focus area going forward from the capex themes perspective. And this is also we are focusing in our ACE equity portfolio that we are managing at our end. Lastly, the recent domestic data points which have come out, and I think just have a focus on that. For example, the toy imports in India in 2018-19, we had $304 million of imports. Now it has reduced to just $36 million. In fact, the export also has improved from I think $100 million to almost $175 million. If you see the defense exports, as I said, it was hardly 1,000 crores in 2014. Now it is 13,000 crores. Corporate credit growth, which was hardly 5% last year, now it has moved to almost closer to 15-16%, which is 9-year high. So this is something which is leading to a revival in the banks, particularly the bigger banks, which have a good NIM pickup also when the interest rates move up, because they first increase the lending rates and then they come to the deposit rates. If you see in mobile manufacturing, there is a complete turnaround now. 90% of mobiles were imported before. Now, whatever mobiles we are using in India, 97% are being manufactured in India only. So you have seen that after Foxconn, Wistron, Pegatron actually, which is a Taiwan giant, it has also come for iPhone manufacturing now in India. And this is something which is continuously picking up. I think 25% of iPhone manufacturing ultimately is going to be shifted to India now by 2025. That is what the target is. Manufacturing PMI in India, it hit the 8-month high of 56.4. Now for September, it has come down a little bit to 55.12 now. So, but it is in the expansion mode. And this is the focus area for the equity markets going forward. Power consumption has grown 3-4% now. Trade deficit has moved up because the exports have reduced. So we have seen the merchandise export had a structural change, but for a few months we can see that the exports can remain lower because there is a recessionary scenario in the developed markets, and that is where when the export numbers are lower, but the rupee is depreciating, and it all depends upon crude, because if crude prices are lower, ultimately we can compensate with rupee depreciation and exports getting lower. But when the crude prices starts moving higher, then you will have a little higher current account deficit numbers also. But for the time being, for financial year 23, market is panning out 3% of current account deficit. Auto sales have shown positive trends. This is clearly we have seen. If you see in the passenger vehicle, which is coming up now, previously 25% was SUV, now 50% is SUV. And that is the reason why Mahindra has done really well, which has increased its market share in its segment now to closer to 10%. Mahindra Scorpio, obviously when it was launched, we had seen 1 lakh bookings within 30 minutes. That shows, the enthusiasm towards these kind of SUVs in the market. E-way bill generation, this shows the movement of the vehicles. It has reached 37% from 5.5 crore pre-pandemic average to 7.6 crore bills now. So this is another heartening factor for the movement of goods and the trucks and all. Now, if you see the cement, because despite being the second largest producer of cement, India's per capita consumption is 250 kg. While if you compare with China, it is 1600 kg. So we are much lower. So when we are focusing on housing capex, when we are focusing on infra, there is a large possibility of more requirement of cement. And that is where these companies now are going for more capacity buildup. We have seen Adani is going from 70 to 140 going forward. And there may be some inorganic acquisitions over there possible. And but the cement demand is expected to 1.2 to 1.4 times of GDP going forward. $1 trillion investment in infrastructure and housing is going to be seen. Cement is helpful for emerging logistics, green energy, and e-commerce business also to get developed. So this is how when the sectors are getting cheaper. So cement sector has got cheaper in the recent period because they were not able to increase the output price. and when the input price was higher. But now petcoke prices have come down significantly, and they are able to increase some of the output price also. So there was some reversal in those stocks. That is how the things are coming back. It will be more stock specific. I think in the month of October, Nifty possibly may not find the final direction, but it is always good if it remains within 16,500 to 17,500 in that band. If it spends more time, I think it is healthy before the final breakout above 18,000. But there will be more stock specific opportunities, capital goods, consumer discretionary, some banking space, and the oversold sectors. For example, IT, pharma, because rupee has depreciated, some reversal from sometimes we can see in those particular sectors. So that is what the whole idea about the market in the month of October is. And this is all from my side. So thank you very much.